The market could reap 10,000 points, and retail will still panic over a 1 point dip. Can the memory and storage sector keep printing all-time highs? Last night, US semis and storage stocks took a massive dive. Sendix puked 6% at one point, flushing out a ton of panic sellers. But out of nowhere, Seagate dropped an absolute monster earnings report that completely blindsided the shorts. Gross margins hit a staggering 47%. They aren't selling hardware anymore. They're literally printing money. Seagate's CEO came out swinging with massive confidence. Their entire 2027 inventory is already sold out, and they hiked their multi-year revenue growth target to over 20%. This instantly triggered a massive capital rotation back into the sector from funds terrified of an earnings black swan. While upcoming tech earnings will still carry a heavy sell news risk, the storage sector might have just completed a massive macro repricing off the back of Seagate's print. In the short term, expect this sector to climb the wall of worry and challenge previous highs. Moving over to gold, the short-term bears have been in absolute control lately, surprised by sky-high oil prices and a massive leadership earthquakes at the Fed. The bulls have been completely suffocated. We have the Fed rate decision in just a few hours, but honestly, the actual numbers are a nothing burger. The real market mover is the leadership shakeup. The entire market is hyper-focused on one thing. Is Powell going to completely walk away from the Fed? He still holds one major trump card. Even if he steps down as chair, he can stay on as a Fed governor until 2028. If he chooses to stay, he can act as a massive check on the new administration's policy trajectory. But if he just washes his hands and walks away, Kevin Walsh gets absolute control. The Fed will undergo a brutal hawkish regime change. If that happens, gold is going to get absolutely hammered in the short term. But remember, I'm talking short term. Long term, my macro thesis remain intact. Gold will bounce and print new all-time highs. Now, crude oil is where things get really spicy. The biggest bombshell is the UAE just officially announced they are quitting OPEC. This isn't just a simple exit from the group chat. It's a blatant declaration of war. We are ramping up production. OPEC has always had a chronic problem. Everyone publicly agrees to cut quotas to prop up prices, but behind closed doors, members secretly overproduce and sell. The rules are actually a joke. The UAE is finally sick of it. They have massive spare capacity, but they've been forced to watch the output get handcuffed by these quotas. By leaving the cartel, the UAE has the potential to instantly flood the market with 1.6 million barrels a day. That's roughly 1.5% of total global demand.
Well, I think the timing of the UAE's exit is quite telling. They definitely want to cash in on the current high oil prices.
The fundamental bull case for crude remains rock solid. And the US is still refusing to lift the blockade in the Arabian Sea. Combine that with the closed trade locking up supply, and you have an unsolvable bottleneck in the short term. However, this UAE exit is a massive warming shot. Once OPEC loses grip and more countries go rogue on production cuts, the entire oil supply demand order will collapse. Violent whipsaws in oil prices are about to become the new normal. And as always, this is just my personal trading analysis, not financial advice. And also shout out to EBC Financial Group for sponsoring contents.